Hello and welcome to CNBC-TV18. You're watching Markets Today, the show where we track about 6 hours of the day's trading action in 5 headlines. I'm Ekta Batra. Here are the headlines for the day. A late rebound helps Indian equities end in the green after a highly volatile session. Sensex and the Nifty close 0.5% higher. Auto surge while IT falls. Nifty IT index falls close to 2%, with TCS and Infosys also seeing big cuts. This is as major IT companies reduce their variable payouts. JP Morgan downgrades the sector. Global crude oil prices inch higher as supply concerns resurface to overshadow demand worries. Saudi Arabia floats the idea of output cuts by OPEC Plus to support prices. Traders fear a drop in US crude inventories. Gas prices also surge to 14-year highs. Auto stocks were in pole position after strong demand expectations. The index surges 2%. Stocks like M&M and Eicher Motors gain 3%. Sterling and Wilson gains after it wins around a 2,200 crore NTPC order. Lupin and Cipla gain after brokerage upgrades. All right, well, let's tell you, here's a lineup of what we have in store for you. It's a packed show today. In Market Opinion, we have Nilesh Shah of Envision Capital. In Corporate Voices, we have Venu Nair, MD and CEO, Shoppers Stop. And we have a lot more perspective lined up for you on the show. But let's get to the first story then. The bulls clawed back in trade as stocks made a dramatic recovery on Dalal Street after an early fall. The Sensex gained over 300 points to go back above the 59,000 mark. And the Nifty gained nearly 100 points, with the mid-caps and bank stocks leading the rally. Anuj Singhal is here with the market action.
Well, the market had a very strong bounce after the morning session, or rather the first hour, which looked extremely weak because of the global cues. But both the Nifty and the Bank Nifty bounced right from the 20-day moving average. And auto stocks, as has been the case, led the sort of rally once again. In fact, in terms of the auto names, you had Eicher Motors, which made a fresh 52-week high. Mahindra & Mahindra is nearly there, and Tata Motors was also quite strong. Some other heavyweights which sort of participated in the move or led the market move from the lows, Reliance, ICICI Bank and State Bank of India. The commodity stocks also did well today, so names like Tata Steel, Hindalco and Coal India were all higher. The only sort of weak point in the market today was IT, large cap IT in particular. Names like TCS, Infosys and HCL Tech, though off the lows, but still a bit of a weakness for IT names. In the F&O space, we had some big gainers like RBL Bank, IDFC First Bank and NMDC. All in all, the market's been making these kind of large moves in both directions. But what today has done is it's given us a bit of a line in sand around the 20-day moving average.
Okay, all right, Anuj, thanks very much for that. So definitely a comeback. But let's get some market opinion then. Nilesh Shah of Envision Capital said that many of the stocks in the broader markets are in a solid bull market. Added that many tier 2 banks and defense-related companies are looking good. Listen in.
What we're really seeing is that a lot of stocks, a lot of sectors, especially in the broader market, are actually in a very strong bull market, and that's really where the opportunity is for India and investing into India. And tier 2 banks, the auto component space, the capex plays and defense, these are some really very interesting opportunities, and I clearly believe that sectors like these are going to be in a very strong uptrend and in a very strong bull market. Clearly, if global equity markets are going to be under pressure, if the US tech space is going to be under pressure, if indices like the Nasdaq are going to be under pressure, it's quite possible that we would probably see some softening or moderation in the valuations. Maybe it's not time to be in the generic IT services companies and be in the specialized mid-cap tier 2 IT services companies. That's where the opportunity is going to be from a multi-year horizon.
Okay, so that's the word coming in from Nilesh Shah. But let's get in some more opinion. Cameron Brandt, the director of research at EPFR Global, said that the rally in the US market was not supported by good flows, called it a summer rally. He also said that he is seeing an increased interest from investors towards the Indian market.
The rally we saw, certainly from a fund flows perspective, was not heavily supported. It had some of the characteristics of a summer rally where a relatively modest amount of money can move asset prices more than perhaps more heavily traded periods of the year. And I'm certainly sort of seeing the turn downwards we've seen in the past couple of days as sort of part and parcel of that general pattern. India's the economy you're most frequently measured against, which is China, has sort of run into definitely a sticky patch. So we've seen a definite uptick in interest in India with funds based outside of India and with more of a long-term perspective.
Okay, so that's some market opinion, but let's get to the second story this evening now. Indian IT stocks were under pressure with the index seeing cuts of close to 2%. This is after Infosys fell over 2% as the IT major cut its average variable payout to 70% for the first quarter. How will this affect margins for the company? Money Control's Haripriya Suresh joins in with the details on this story.
In what has become an industry trend, Infosys is now the latest company to make changes to its variable payouts for the first quarter of FY23. Infosys has told employees that they will, on average, the employees will receive 70% of their variable payout, but it depending on what their pay grade is and what department they're from. It has attributed this to margin pressures, primarily because of compensation revisions that it has done, as well as talent that it has hired. This, of course, comes soon after both Wipro and TCS have made similar announcements. TCS has deferred the payout for certain grades of employees, whereas Wipro has said that anyone in band C and above will not be receiving the variable payout for this quarter. This, of course, for Infosys, its Q1 operating margins was at 20% and its attrition was at 28.4%. All of them are seeing significant increases in wage costs as well as increased attrition. And what the impact of this move will be on Infosys attrition levels remains to be seen.
Okay, all right, Haripriya, thanks very much for that update. But it's not just Infosys. Other IT companies like Wipro and TCS have also cut their variable pays. So what is the variable pay component and how does employee cost affect revenue performance? Reema Tendulkar is here with the details on this story.
Thanks so much for that. I just want to put in context the news that we're hearing from Wipro and now Infosys about variable pays being cut, and TCS as well. You know, there were reports about how they've deferred the variable pay by 1 month for a few employees. For one, variable pay is based on performance. So it's left at the discretion of the company based on the employee's performance. Also for an IT company, the variable pay is usually a part of the CTC and it's not a significant percentage. Also, that another point that's being made is that if IT companies are bringing down the variable pay, will it hurt the attrition? Will we start seeing attrition levels go up? My sense is that unlikely, because IT companies have given heady payouts to employees over the last 2 years in this whole post-COVID digital boom. Now take a look at TCS. While TCS has not brought down the variable pay, we're just using this as an example. TCS's employee cost as a percentage of its sales has gone up by 300 basis points in a span of about 3 years. That just gives you a sense that companies in the last 2 years have handsomely rewarded their IT employees, and therefore this year, if they bring down their variable pay by a small percentage margin, it's perhaps unlikely that it's going to impact the employee morale. Also, we had Info Edge telling us that how even for this year, the core employees are going to be given a salary hike of 12% versus historical levels of 7 to 8%. So even this year, high wage costs have persisted, and therefore variable pay is a small percentage. It's a lever which IT companies have, and they perhaps are looking to flex it given the margin pressures. A word on the margin pressures, yes, they have come down significantly in Q1. Historical low margins for Infy and Wipro in the quarter gone by. For HCL Tech and TCS, margins were at 10 and 14-year lows, and across the board, we had cuts of about 100 to 200 basis points seen in the margin performance of IT companies. So the margin pressures are real, and perhaps IT companies are looking to flex the variable pay lever that they have in order to bring down the costs. But my sense is it's unlikely to hurt the employee morale too much. Back to you.
Okay, all right, Reema, thanks very much for that. But that's not all for the IT space. Brokerages are not upbeat on Indian IT companies. JP Morgan has downgraded its rating on the sector from overweight to neutral as they expect to see margin erosion to persist in the medium term. Nimesh Shah is here with the details.
That's correct. So, the global news flow, the domestic news flow and a JP Morgan downgrade has led to a big underperformance of all the IT stocks in today's trade. Now, the JP Morgan has turned further negative and underweight and bearish on the sector. And today in the morning, they've downgraded all the remaining 4 stocks which they were overweight on to neutral rating. The 4 stocks where they've downgraded are Infosys, Tech Mahindra, Emphasis and Persistent, all to neutral from overweight after the recent run-up in the price action. Now, they expect the margin erosion to persist in the medium term and stay meaningfully below the long-term trends. In fact, they see limited incremental margin levers going ahead for all the IT names. And in terms of valuations, the entire IT basket is still trading at least 40% higher than the pre-COVID levels, despite the fact that most of the peak growth is behind for all these companies and margins are structurally getting eroded. So on back of this, they've done further negative and underweight on the sector. And today they've downgraded all the remaining 4 stocks to neutral from overweight, which is Infosys, Tech Mahindra, Emphasis and Persistent.
Okay, all right. Tough times for IT. Thanks, Nimesh, for that. But let's get to the third story that we're tracking today. Despite choppiness, crude oil prices are trading higher as the focus has shifted to supply-side factors. This comes after Saudi Energy said OPEC Plus may consider a cut in oil production to stabilize a volatile market and prop up prices. This has overshadowed concerns that the global demand may slip on the back of a recession in many major economies. Manisha Gupta joins in with more details.
Well, yes, the concerns about the gas prices is keeping that commodity on the higher side. You have the US natural gas prices trading at a 14-year highs, the European gas prices at all-time highs, and the UK gas prices also trading very close to those all-time highs. This is after Moscow says that the Nord Stream 1 pipeline will be shut down for 3 days starting 29th of August, and there would be no gas supply to Europe and Germany. Nord Stream pipeline in any case was supplying 20% of capacity, and that has brought in a lot of uncertainty. Not just that, when you look at the Black Sea, couple of pipelines there also are shut. There are concerns also that are being seen in UK, Norwegian gas pipelines as well. So the supply side suddenly seems to be very volatile and uncertain, and that is keeping the gas prices higher. US, even as it is the largest gas exporter right now, the inventories with them also is 20% lower than the 5-year average. So there is a concern coming in, and come winters, you will be looking at higher demand. From 5th of December, European Union also is cutting off Russian oil and gas imports. So there are, as we head into the later part of this year, there are more and more uncertainties coming in case of gas prices, and markets, we do believe that we are headed higher when it comes to this sector.
Okay, all right, Manisha, thanks very much for that. So definitely gas prices in the US at 14-year highs and only rising further. The energy crisis is worsening amid a surge in these prices. RBC Capital Markets' Helima Croft says Europe's resolve on sanctions is key for oil prices. She added the gas prices in the US are likely to rise.
Well, I mean, Europe is going to be ground zero for this energy crisis. I mean, obviously, they are the main importers of Russian gas. The Russians have made it very, very clear they're going to continue to cut off gas supplies into Europe. We're going to have a 3-day outage on Nord Stream 1 starting on August 29th. But we can expect the Russians just to keep the pain up in order to try to force the Europeans to change their calculations about sanctions, about supporting Ukraine. So, yes, gas prices in the United States will also rise, but Europe is going to be really where the pain is going to exist with this war. Russia's only 3% down below pre-war levels. India's taking Russian oil. Turkey, China. What happens, though, on December 5th? That European embargo kicks in. 2 million barrels of Russian oil isn't going into Europe. If those shipping and insurance sanctions kick in, it will be difficult to move those barrels to Asia. The question is Europe going to be in such a difficult economic situation if they don't go forward with those sanctions? To me, that is going to be the key determinant of where prices are. Europe's resolve to see this through in terms of Russia's sanctions.
Welcome back. You are still with us on Markets Today this evening. Let's get to the rest of the headlines that we're tracking for you. The fourth headline this evening, the auto index gained close to 2% on the back of strong demand expectations. Eicher Motors surged over 3% after a CLSA report that maintains a buy rating on the stock. Eicher Motors is their top bet in the auto space. Sonia's here with more.
Well, thanks a lot for that. Eicher Motors was clearly the stock of the day after it hit a fresh 52-week high and has gained over 35% in 2022 already. In fact, in the month of August alone, the stock is up about 12% and a lot of brokerages are quite bullish on the stock. CLSA put out a note today where they said that Eicher Motors is the top pick in the auto space and they have raised their target price to 4,154. They say that most Royal Enfield customers do come back and replace their old vehicle with a new one after a 7 to 8 year lifespan, and they believe that 80 to 90% of this fresh demand could be enjoyed by Royal Enfield once again, which would lead to higher revenues. Not just that, exports are a huge growth area for them, and the EBITDA per vehicle is expected to improve significantly because of the falling raw material prices. Currently, the EBITDA per vehicle for a Royal Enfield bike stands at 42,000 rupees. It's expected to rise to 46,500 rupees on account of lower commodity prices and better operating leverage. It was clearly one of the stocks of the day, hitting a fresh 52-week high.
Okay, all right, Sonia, thanks very much for that. Well, on to the fifth story then. Sterling & Wilson surged over 4% after the company won a 2,200 crore NTPC order. Nigel is here with more details on this story.
Well, that's right. Sterling & Wilson, they won an order worth nearly around 2,200 crore rupees odd. Remember, they have been declared as L1 bidder for the BOS package. Now, that compromises of 4 blocks of the proposed solar PV plant of NTPC. And keep in mind, this project is in Gujarat. So, on the back of this order win, well, Sterling & Wilson bounced up in trade. Back to you.
Okay, all right, Nigel. Thanks very much for that. Well, the other two stocks which I'm tracking today is that Lupin, which gained almost 2% after Nomura report maintained its buy rating on the stock. However, Gland Pharma ended lower by around 0.5% despite a buy rating from Goldman Sachs. So more details on that then. Nomura on Lupin, they maintain their buy with the target which is cut to around 863 rupees. The stock, according to them, factors in current stress and a high contribution from India as well as growth markets provide downside support. Revenue growth will be a key driver for margins going forward. Continued tight leash on overhead costs will drive margins. The company has, Nomura has cut their target multiple, reflecting headwinds in the US business. But moving on, for Gland Pharma, it was in focus because Goldman Sachs has initiated with a buy and a target of 2,830. It's a leading global generic injectable player, addressable generic market size of $138 billion by FY27 estimated. They expect a rebound in FY24, modeling 27% top-line growth, a pickup in the rest of the world as well as India sales, improvement in US and core markets to double-digit growth, and increasing production capacities and utilizations at key facilities are a couple of key points which will help in terms of driving growth going forward. But staying with the entire pharmaceutical space, here's a CNBC-TV18 exclusive. Drug maker Cipla has big plans for its business, which include doubling its revenue from its India and US markets over the next 5 years. A large portion of this expansion will come from its wellness business, which has seen some good traction across customer categories. MD and global CEO Umang Vohra says the plan is to use both acquisitions and new product launches to grow the business fivefold into a 3,000 crore business over the next 5 years. He also said that the company will work on deepening the India and US markets through innovation and entering new areas.
What we're seeing in India is incredible amounts of deepening of the healthcare market into tier 2 and 6 towns. We are seeing a wave towards wellness markets across the world. So that will be growth driver number 1 for us, which is just the deepening of the presence of healthcare in India and the evolving consumer healthcare space.
Let me start by addressing the wellness segment that you spoke of. And as you pointed out, you have aspirations of building that out even further. How much of that is going to be driven inorganically? Is that an active discussion that you're having with potential players at this point in time? And what would the size be of that business, and what kind of investments do you hope to make within that space?
So we have very large organic brands in the wellness space, and our objective would be to grow and deepen these organically first. Of course, inorganic is a part of the strategy. But I think if you look at just the depth of our organic brands, we have several brands which are 200 odd crores big. The total business right now is about 600 crores. we can see this business growing on the health side itself to close to about 2,500-3,000 crores over the next 5 years. So we are very bullish about consumer wellness. I think this is a business that will require us to be a lot more D2C oriented as well, in addition to creating equity for these brands with doctors and with patients. So we have large number of brands in the pain space. We have a large franchise in the vitamin space. We are the leaders in the nicotine replacement therapy. And over a period of time, we will create more brands in the cough segment. We will create more brands in the mom and children segment. And I think we feel very bullish about this category in India.
Okay, all right. Well, let's get to another exclusive then. Sources are telling us that Rare Enterprises-backed company IKS Health will file its DRHP with SEBI next month. Yash Jain is here with the details.
Well, that's correct. So just last month, Rare Enterprises backed another company, Concord Biotech, filed its DRHP with market regulator SEBI. And now there is another new company, which is again Rare Enterprises backed, which is IKS Health. And sources tell us that the company is preparing the documents, and is expected to file the IPO DRHP with SEBI as early as next month, that is in the month of September. As far as the IPO for IKS Health is concerned, it is expected to be a complete offer for sale issue. There is going to be no fresh issuance of equity, which means the stake sold by selling shareholders and the funds raised will be taken by the selling shareholders, and nothing is expected to come into the company. As far as the size is concerned, according to our sources, 2,500 crore is expected to be the size of that IPO, with issuance of about 15% equity. The IPO is expected to value IKS Health at about 16 to 18,000 crore rupees. That is what our sources are indicating at this point of time. The IPO is expected to be launched only next year in the first month itself, about January 2023. Now, Rare Enterprises, which is essentially a promoter of the company, owns about 54% stake. Utpal Seth, who's the MD and CEO of Rare Enterprises, is a director on IKS Health, as well as Amit Goyla, the head of research and investment at Rare Enterprises, is also a director with IKS Health.
Okay, all right, Yash, thanks very much for that. And on that note, it's a wrap on this edition of Markets Today. Thanks very much for watching.